Hello, my name is Steve Walker and I'm from Promise Money, and today I want to talk about debt consolidation, and I want to cover some of the key points within debt consolidation that affects borrowers. So I want to talk about the benefits, I want to talk about the pitfalls, how it works, some of the alternatives and the things that you need to think about. So let's firstly talk about how does it work? How does debt consolidation work? It's very simple. You take a number of loans that you already have and you consolidate them into one debt, and hopefully the result of that is that you have it at a lower interest rate and very often over a longer term. So that means that the repayments come down quite significantly. The whole idea of debt consolidation is to reduce your outgoings. It's not necessarily to allow you to borrow more, it's to reduce your outgoings so that you can restructure your debt. That's really what it's all about. So by extending the term, getting better interest rates, you should be able to get much lower monthly repayments. But an important thing is, don't think of it as an excuse to go and borrow again, because just going and borrowing again means that you're racking up more debt, okay? And that could cause you a problem at some point in the future, especially if interest rates go up. So think of debt consolidation as part of a solution to not necessarily a problem that you might have right now, but to help you right now. Because just because you go for debt consolidation doesn't mean that you're in chronic debt and you can't afford your repayments. In some cases, you might just want a better lifestyle. You might just want to have more disposable income each month. So that's the theory behind it. I just want to go through some worked examples now, just to show you, I guess, some of the considerations when you are consolidating debt, show you how it can work for you, and sometimes it might not be the right thing for you. So I've got a very simple example here. You've probably been looking over my shoulder anyway and trying to work it all out. So this is an example where we're looking to consolidate maybe a £7,000 loan, unsecured loan over 5 years, so the rate of 11%, a credit card. Now, credit cards are revolving credit, but generally they've got a minimum payment that you have to make each month. And we put that in at 3%. So bear in mind, this is a loan, and by paying £150 a month, you're actually reducing this balance. With a credit card, you're probably not reducing the balance if you're making the minimum payments. But that's the scenario. And then we've got another credit card here, again, revolving credit, 3%, minimum payment of £180 a month. So you've got £15,000 worth of credit there, and you're paying £390 a month. So the typical scenario could be that you say, right, I'm going to take out a consolidation loan. I'm going to take it over a longer term. So I'm taking that £15,000, I'm restructuring it over a 15-year period, and I'm getting a lower rate of interest at 4%, because remember, that's 3% per month, at 4%. So I'm now paying £102 a month, and I'm saving £288 a month. That is the theory for debt consolidation, okay? Reducing your outgoings. But there are lots of considerations to think about. Now let's take, the first consideration is, you might be moving on to a secured loan. This is unsecured debt. This could be a secured loan, and we'll talk about that in a moment. Another consideration could be that this credit card could be at 0% interest. So you're still making minimum payments, but it's at 0% interest. Therefore, you're not saving on the interest rate, but you've still got to make the monthly payments. So there's a conversation to be had there with yourself and with an advisor, if you've got one, to say, well, do I want to move my 0% to 4% in order to save me some money each month? And the answer to that might be, well, yes, actually, that's a price worth paying, because in this case, you're paying £180 a month, and that could be what's crippling you. Even though it's on 0% interest, you've got to make the minimum payments. You could have a scenario where you're on 0% interest at the moment on a credit card, but it's soon going to roll over into the default interest rate, i.e. you're coming to the end of the offer. And it's going to go up to, it could be 10, it could be 20%. So again, that's a scenario where you might want to look at debt consolidation. I think the key thing here is, don't necessarily consolidate every bit of debt you've got unless it's the right thing to do, and that's where advice comes in, okay? Because it might not be the best thing to do for you. But what we must recognise here is, you've taken unsecured debt here over 5 years, and if you kept paying that off, you get it paid off in a shorter period of time, because it's only 5 years. So it isn't a magic formula, because what you're doing here is you're saying, okay, I'm going to stretch it over 15 years. I'm paying £102 a month, but I'm paying it for longer. So unless the interest rate is significantly less than you're paying at the moment, you could actually end up paying more interest over the long term because you are paying it for longer. However, you're going to be paying less each month. So again, there's that calculation to do. And don't automatically go for a 15 or a 20-year term if you don't need to. Okay, so let's talk about different types of consolidation loans. Well, firstly, you've got unsecured loans. Now, unsecured loans, generally speaking, are very much dependent on credit score. So if you haven't got a really good high credit score, a unsecured consolidation loan may not be an option for you. And the reason for that is, if you haven't got a really high credit score, you're probably not going to qualify for the really low interest rates available on some unsecured loans. The other thing is that a lot of unsecured lenders don't like debt consolidation. They don't want to take on somebody else's debt. They want to lend you new money. So they don't want to help people out of trouble, and they don't want to take on other people's debt. So unsecured loans, it's more difficult to get a debt consolidation loan. But if your credit score isn't absolutely bang on and you don't qualify for one of these, let's call them a premium rate, a really good rate, then it's very easy to drop very, very quickly into interest rates which make debt consolidation really not sensible. So I'm not going to say these are subprime credit cards, but it's very easy to move from rates of 5 to 10%. With a poor credit score, you could easily be into 25 to 49%, and you'll see lots of unsecured loan specialists quoting typical rates of around about 49%. Now, at 49%, if you're paying 11%, and because it's unsecured, they're probably not going to lend over such a long term anyway, you're going to be worse off. So that's possibly not a solution for you. An even worse solution would be to rely on payday loans, because if you're already in debt and you're already struggling to make your repayments and you go for a payday loan, well, their rates can easily be 1,000% and you have to pay them back very, very quickly. Please beware payday loans. Not just because they're expensive, but because any lender that's assessing you for future borrowing is going to look to see whether you've had payday loans. And if you have, that is really a marker that perhaps you've tried every other avenue and not been able to raise money. So that is a sign of stress. So a lot of lenders will say, if you had payday loans recently, we really don't want to lend to you. So watch out for payday loans. Okay. So in summary, unsecured loans for debt consolidation, you might find a satisfactory solution, but it's probably unlikely. I'm not saying don't try it, but it's probably unlikely. Okay. Now let's just move on. Now, if you're a homeowner, you could take a secured loan out. Obviously, it's subject to the equity in your house. It's subject to full affordability assessments, and your home is at risk if you don't keep repayments on it. So that is the big downside, is you are converting unsecured debt to secured debt. But with secured loans, you can borrow larger amounts, and in these examples here, £15,000, it's very, very typical for us to be looking at consolidation loans of £50,000, £70,000, £100,000, where people have run up a right load of credit and they now need to get it back under control. So with a secured loan, you can get to those loan amounts. One of the advantages of a secured loan is it's going to be secured on your property, therefore it's regulated, therefore it has to be fully advised by a qualified advisor. And that advisor has to make sure that the outcome is suitable for you. So they might tell you, actually, you don't want to consolidate your debt, you should be looking at an alternative. So they have to think about these things. So let's just talk about the options of remortgage versus a secured loan, because you could also remortgage. So a remortgage means taking your existing mortgage, borrowing the extra amount, in this case £15,000 that you need, and remortgaging your property. Well, in some cases it might not be suitable advice because of the deal you're on at the mortgage, on the deal you've got with your current mortgage at the moment. Just to remortgage for an extra £15,000. It could even cost you more because that deal's better than the one you can get right now, especially with rates going up, or there could be early settlement charges that you have to pay. But the other factor is that most mortgage lenders aren't terribly keen on unsecured debt consolidation. They're okay with consolidating secured debt, but they don't like consolidating unsecured debt. Also, Affordability is crucial, and more so with mortgages, because the lenders have more restrictive terms. But if you are going to use your home as security for debt consolidation, your advisor should consider a remortgage as part of the whole advice process. So only go to an advisor who's going to look at both a remortgage and a secured loan and compare them side by side. If they don't do that, then find a different advisor. Okay. Let's talk about secured loans now. So a secured loan, again, secured on your property, sits behind your mortgage, but they are very much more geared up for debt consolidation. They are used to it. It's how the market has evolved, very much looking to help out people who need to consolidate debts. They'll go to high loan to values, so you can raise more money, and they're more generous really than most mortgage lenders on affordability, and they're good at handling niche scenarios relating to income for self-employed, for contractors, etc. So secured loans are a product typically used by homeowners for debt consolidation. In terms of loan amounts, 10, 20, 30, 100,000 and more. You know, you can get secured loans up to £1 million. I'm sure you're not going to want that for debt consolidation, but it gives you an idea. Terms, depending on your age, up to 25, sometimes 30 years, so you can bring your repayments right down. And interest rates from 3.5%, roughly. I mean, you'll see 2.9 advertised maybe, but that's pretty rare. So from 3.5 to 4 to 4.5% is sort of the sweet spot for secured loans for people with good credit. But even if you haven't got a really good credit history, secured loan lenders are really good at dealing with that. They'll disregard a lot of adverse credit which is over 12 months old. So you still could be looking at rates of 6, 7, 8%, even if you've got very bad credit. So secured loans, they really are geared up for this type of product. So just thinking about that now, you know, if you had a secured loan of £15,000 at 4%, £102 versus £390, that's the sort of saving that you could potentially make. But don't forget, it's secured on your house, and you are taking the term over a longer period. I've gone for 15 years here. You can imagine if it was a 20-year term, that would be considerably lower, probably £80 or something like that. So it's a tool, but don't think of debt consolidation as something that you just do because you can. We have repeat offenders who consolidate their debt, get their debts right down, and then they go and rack up a whole load more on their credit cards and come back and say, I need another consolidation loan. That isn't the way to do it. If you're going to consolidate your debt, think about it very, very seriously as a credit repair tool, but also a tool to help you manage your outgoings. So don't automatically go and get more credit, because if interest rates go up, you need to be able to afford all of your priority payments. You need to be able to afford your mortgage or your secured loan or your rent or whatever it is. So don't automatically take out more credit. It's really, you know, it's an area where people need to be very, very responsible and don't fall for the buy now, pay later gimmicks that a lot of retailers use to sell you products. If you can afford it, buy it, but your advisor is going to help you with this, because what the advisor will do when they arrange a secured loan or a remortgage for you, they're going to factor in increases in rates to make sure that it's affordable both now and in the future. But if all of a sudden you go out and you get a load more credit and then come back and they say, oh, I now need to consolidate this, you might not meet the criteria required for that secured loan lender, because if you've already maxed out on your last loan, don't expect to get another one. So I guess what I'm saying is just responsible borrowing is the thing. Be a responsible borrower. Okay, so that's unsecured loans covered, that's secured loans covered, and that's remortgages covered. Now, there is another alternative, and this is really aimed at people perhaps who have got into a little bit of problem with their credit, because not everybody who wants a consolidation loan is in a problem, and that's debt management. So a debt management plan doesn't involve borrowing, it involves approaching your creditors and agreeing reduced payments for them, with them, sorry. So you're agreeing reduced payments because you can't afford to pay your debts, and you'd have to evidence to them that you can't afford it. And this actually is a good way of managing your debts, because you're paying less, so it gets your outgoings down, but it does mean like on extending a loan, you're paying for longer because you're just saying, I'm going to make reduced payments and I'm going to catch up later. Okay, but there is another big impact on this, and that is if you've got a good credit history right now and you go into debt management, then all of those loans that you've got where you've come to an arrangement are going to show on your credit search as an arrangement, and that's going to make it very, very difficult for you to borrow. If you're on a debt management plan now, many lenders are going to say, no, we're not going to lend to you because you're on a debt management plan, and that means, in our minds, that you've got a problem. So you need to be very, very careful before you go on to debt management and take advice and speak to some of the government-run organisations that help with that. Okay. So debt management, it does have a place, but for me, if you've got a good credit history, it's probably not one to consider too strongly. If you've already got a bad credit history, then you've probably not got so much to lose. So that's a scenario. But again, I'd say speak to an advisor and they'll tell you. Couple of other factors that I just think are really, really important in summary. Just because you can consolidate your debt, and let's say you've got £100,000 worth of debt, it doesn't mean that you should. Talk to your advisor, look at whether you can actually leave some of that outgoing, because you can afford it. If you can afford to leave some of it in place, it may make sense in this scenario here, for example, just to pay that down as quickly as you can, especially if you've got a 0% credit card. Why would you consolidate it if you've got the outgoings just to make extra payments and pay it down? So don't automatically consolidate everything. Talk to an advisor, and don't automatically take it over the longest term just to keep your repayments down, because all you're doing is taking longer to pay it back. If you can afford to pay it back sooner, take a shorter term, or ideally take a loan that allows you to make extra payments every month to reduce the balance. But don't fall into the trap of getting used to having that extra disposable income and just going and spending it. Use it to pay the debt down. So, in summary, debt consolidation is a good solution for many people. It's part of a strategy to help you manage your debt. It will reduce your outgoings, or it should, but you could be paying more over the longer term, depending on the term you take and the interest rates you were on and you're moving to. Don't borrow more just because you can. Don't borrow for longer just because you can. And don't borrow more after you've taken out the debt consolidation loan just because you can, because if rates go up, it could leave you in a stressed position where you actually can't afford your priority debts. So be careful before you do that. The big key thing here is debt consolidation is easier. There are more options if you are a homeowner and you've got equity in your home, because there's just so many more options to deal with so many different scenarios, especially if you've got a little bit of bad credit, or you're looking for a larger loan, or you're looking for a longer term. And the key message here is always get advice, because if the loan is secured on your home is at risk. It's a regulated loan, so you need to speak to an advisor, and it should be an advisor who deals in both secured loans and remortgages and knows their way around a debt consolidation as well. I hope you found this useful. There's a lot to take in there. Have a look on our website. There's more information about debt consolidation, but the best thing to do is to pick up the phone and talk to somebody who can then take down all of your information and go through an exercise like this, but in a lot more detail, to work out what's a good idea, what's a bad idea, and present you with some options and some advice. My name's Steve Walker, Promise Money. Please subscribe to our channel. Please share this with anybody you know. You'll find more information below this video, somewhere down here, if you need it. Thanks a lot. Bye-bye.